Hello, everyone. Chris Martinson here, back with Paul Kiker of Kiker Wealth Management. Hey, Paul, good to see you back.
Hi, Chris. It's nice to be back. Good to see you.
Oh, man, we got so much to discuss today. We got the U.S. credit downgrading by Fitch. We got some oil stuff on my side. I know you've got some stuff, but first, we didn't see you last week. Where were you?
I,
What were you
I,
doing?
I was out side of Jackson Hole, Wyoming, one of the most beautiful airports
Mm,
I've been in and out of. Magnificent. Fly fishing in the Alpine, Wyoming area. So it was fantastic.
man, how did that go? Did you catch anything?
We did. We caught a lot of fish. I taught the
Yeah.
guys, the individuals that went on the trip with us. I taught them into a horseback ride. So we get out there and we think we're doing a 2 to 3 mile easy ride. The outfitter forgot that we were supposed to be going fly fishing. So instead of losing us for the day, they carried us to an alpine lake. And I'm just glad we all survived that ride. I think it was 4.5 hours in the saddle and some unbelievably dangerous terrain. And I think it still hurts to sit down today. So it's 4.5 hours up and 3.5 hours back down. And we were going to do it for 2 days. The guy said, no, we're done. Sunk cost. Let's go on and let's just wade. So beautiful
Yeah.
country, remote, lots of unbelievable cutthroat trout. So it was a great time.
Unbelievable. Oh, man, I'm jealous. I love fly fishing. That was a super passion of mine when I was a young teen and through my I've never lost the passion, but I mean, let me tell you how passionate I was. I raised my own roosters because I was unhappy with the cost of high quality hackles from Orvis. Okay, that's how
That's passionate and that's impressive. That really
that, that's I was the guy. I would tie flies and put my snorkel and mask on and drop them and look at them from below just to anyway,
Oh,
I
wow.
got pretty into it.
You do everything 150%, which is great.
I was just born that nobody taught me. I didn't have any parents sort of instructing me. Probably that's why it happened, right? If somebody was telling me to do that, I wouldn't have done it because I'm a contrarian. So so
That's
hey,
great.
I'm going to share my screen here because I want to get going on this. Let's see, maybe this one here. And so yeah, let me supersize that. So I do want to talk about the U.S. getting downgraded, right?
Yes.
So this is the downgrade of the United States credit position. I do want to talk about that, but before we get going, just reminder everybody, this is for educational purposes only. If you have any financial decisions you want to make, please consult an appropriate financial advisor. Of course, Paul Kiker and his team are. And Peak Prosperity, we operate something called Peak Financial Investing, which is a promoter of Kiker Wealth Management because we believe in what they offer and what they do. Did that advance? Did you see the something's not happening on my screen here? Are you seeing this?
I'm
The
seeing it.
text?
I can see the
Oh,
text.
okay.
Yeah.
Yeah, my other screen is frozen for some reason. So as long as you're seeing it, okay. How about this? Liberty lockdown. Clint Russell. Clint and I know each other. He's interviewed me a couple times, so he's a good guy. But he says they printed over $5 trillion in a single year, and this turnip calls the U.S. credit downgrade puzzling.
That's perfect. That is
Yeah,
perfect.
Janet Janet Yellen, she is a turnip. I think I've lost a lot of respect for her. Watching her go over to China and bow, to an undersecretary of commerce, her statements where she's just puzzled all the time. She doesn't seem to understand anything, which is fine. I get it. So she's got a point of. She feels like her position is she has to gaslight and lie to the American people. And so she fits right in with the whole DC crowd because they can't just come out and say, yeah, we have a pretty concerning situation here. Our fiscal house is not in order, and we're going to pile on a minimum of $1.2 trillion per debt per year for the next 10 years. It could be higher. Recessions, of course, make that higher. And
Yes.
then the consequence of that, of course, has been this. This is the U.S. 10-year. We're looking at a month here. And look at that. It came from about, I'll call that 3.7 to 4.17. That's a pretty big move. It just busted. That's the move today. Another 0.09 basis points on there.
Mhm.
Well, 9 basis points, piled on there in, 9 basis points, 0.09%. Just today. And that's, of course, going to have real impacts because this is, the 10-year over 4 is going to cost some people some money. That's on mortgages, auto loans, credit cards, and of course, the U.S. government, which just got downrated, which is Puzzling. All right. What do you make of that? How do you interpret that?
Well, it's substantial moves, and the interesting part is the markets have really ignored it for the most part. I mean, we've had a little bit of a pullback, but we are in the danger window coming into that August, September, October timeframe.
Yeah.
But I guess there's such a belief that this time is different, or there's such an emotional euphoria out there right now that nobody seems to, the market doesn't seem to be taking it seriously, and this is a pretty serious downgrade. I mean that's not something that I would assume Fitch took lightly when they put that news out there yesterday. So
No, and by the time, remember, I'm old enough to remember that by the time one of the rating agencies, that would be Fitch, Moody's, S&P, right? By the time they downrated, okay, I'm this guy. I got caught. I wasn't paying attention. This is the early 2000. I had WorldCom in my portfolio because my Merrill Lynch broker said do it, right? Like, okay, we're all geniuses coming through those late 90s, right? And I wake up one day and WorldCom is out of business, like they're in receivership, and S&P downgraded their debt
yeah,
that day.
it took them that long.
Like, good job.
A little behind the curve there.
Yeah. So by the time they do something, I assume we're already behind the curve. That's where I'm going with that.
Well, I would think we're behind the curve right now, and that they were slow. I mean, just the massive fiscal stimulus that's been put into the economy. Everybody's realizing that, yeah, they're doing everything that they can to rob from our future to prop the markets up into what, 2024, if they can pull it off, to try to, for political purposes. That's not what's good for the American people. And these higher rates, even though they're trickling through, I think it was Albert Edwards has been talking about the surprising disconnect between interest rates rising and net interest payments on the corporate balance sheet. So corporates have done a fantastic job over the past 12 months of arbitraging that difference, because they're earning a lot of interest on the cash that they have in the bank. They're not having to reset to those higher rates yet, but it's coming. And that's not going to continue forever. So you've got the tech industry, which is very debt heavy. You've got the 10-year that's starting to increase. You've got inflation here recently that's still sticky, and a continuing deterioration in the economy. Granted, not as fast as what everybody was anticipating at this point, but it's still this slow and steady decline that can accelerate at any time, especially in this danger window between August to November. And that's the one thing that I'm talking to a lot of people about right now is I have no clue. There's so much momentum behind the market right now, and we're overvalued. We're detached from really the fundamentals, and the market is speculating that we're going to have this perfect Goldilocks soft landing, potential no recession. Now everybody's talking about it's going to be late 2023, early 2024, which is certainly possible. But again, in 2008, you had Bear Stearns fell in March. Markets kind of rallied into the summer. Everybody was optimistic. The Fed's coming out, giving us good news. We're not going to have a recession. We have the normal correction in August that tends to occur, and then everything spiraled apart with Lehman Brothers collapse. So, the other side of that, what everybody's talking about right now, or at least a lot of traders is this 1999. Do we get this blow off phase here before we go lower? It's hard to tell, but now it's the time to be very careful, be very cautious, and raise that capital. That interview you had with George Gammon yesterday was absolutely all the interviews you do are fantastic, but of course, being in the markets, I really enjoyed that, and just his perspective from a long-term standpoint. Look at the big picture, raise some cash. So what if you miss a little opportunity in the short run, you're in a position that if we have this downturn and we don't bounce and throw into the end of the year, we do continue to deteriorate, and we have this Wile E. Coyote moment in the markets. Doesn't look like it's going to happen, but if we do, if you have cash available, then you can really take advantage of your energies and your commodities and your coppers and benefit yourself in the future and help get that financial freedom.
Exactly. I love that you mentioned financial freedom, because if you have financial freedom, well, you have many more opportunities and options in front of you. And I think everybody should get that. And of course, financial freedom has a bunch of components. One, diversify your income stream. If you have a chance and you got that single paycheck with a company that, you don't know, or a single point. Hey, it doesn't hurt to have multiple streams of income. And then, of course, the wealth that you do save, you got to safeguard that now, because the Federal Reserve has told us flat out, hey, we're no longer comfortable with 2% inflation. We want 3% inflation. Rule of 72, where they said, we're going to steal half your stored wealth in 35 years. Now we think we'd like to do that in just 21 years, right?
That's
It's
right.
it's just like they're telling you straight up, we're going to steal your wealth. And so what do you do about that? And it's increasingly tricky. I deplore that we have to be in that position. But of course, when you're being lectured by turnips,
Hey, I hate to say this, but I was watching her interview with Congress. I guess it was about 6 to 9 months ago. And in the South,
yeah,
we talk slow, right? But we would like, our minds move a little bit faster than our mouths do. But I was so frustrated just listening to how slow her responses were, and just not understanding the questions that she was being asked. So turnip is that's fantastic. That gets the nickname award of the year from me.
well, kind of fits that little mop of hair. It's like the little greens at the top of the root vegetable.
I know. I know. That's oh
Well, I'm
so
laughing because, Paul, I've been very dismissive of her for a long time. I despised who she was as a Fed chair. The only time I felt like I saw the authentic Janet Yellen, because she does this kindly, grandmotherly, bumbly, I don't quite know what's going on, but let me lecture you anyway sort of persona. But it's very carefully calculated. I saw that mask slip when Pedro da Costa dared to ask her a follow-up question in a Federal Reserve press conference. And it was about the fact that there was corruption inside the Federal Reserve, and there were issues of contracts and maybe inside knowledge that had gotten leaked and all of that. And she said, blah, 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 gave some non-answer. And he said, hold up, what about this meeting on this day with these people? And that's when it dropped, and she got fierce. And
oh
he never set foot in that. That was his last moment as a Federal Reserve beat reporter for the Wall Street Journal. He was gone, right? That was the end of that. So
that's
she knows
amazing.
how she knows the game. She knows the game she's playing. But the game is, of course, we're going to gaslight people. We're going to lie. We're going to do whatever. We're just not going to be honest about any of this stuff, And but yeah, turnip. so,
You know,
so
and I still can't help but think about, especially this inflation that we've had here recently now. And I really need to go back and look at the quote, whether it was Lincoln or Jefferson, that said, if we give our power over to the central banks, first by inflation, then by deflation, they will rob you of all your wealth.
right.
And, I mean, if we end up with a pretty substantial deflationary event on the other side of this, which very few people believe can happen, then that's exactly what's going to happen, is they're going to rob tremendous retail investors of their wealth.
Well, of course, you'll own nothing and be happy. I'm not sure about part two, but part one happens through that process of inflation and deflation, right? So Bank of America was a cheesy little regional bank out of San Francisco. And then the Great Depression happens, and they bought up all this real estate pennies on the dollar. That's a deflationary outcome. How did
Mm-hmm.
they have access to cash to buy up all these mortgages of distressed people, right? And there was really, like, I don't know how the country didn't go up in flames at that point, because I was reading stories, Paul, about, like, imagine this: you have a mortgage with a bank, the bank goes under, you lose your asset, which is their liability, which is your deposits, but your mortgage is on their asset side. So people would have their money taken, and then they would have their mortgage taken because they didn't have the funds, because the bank was holding both the liability and the asset. And then the assets went into receivership. That's your mortgage, right? Their liabilities got wiped out. That was your cash. Can you imagine? I mean, that's just like, what?
That's insane. That's insane. And in thinking about the Great Depression, that you got into a level of detail that a lot of people don't think about. I mean, you know it, but you don't think about it in that detail. And that's absolutely, you're right. So wonder people didn't just burn everything down.
Yeah,
Wow.
that's straight up theft, right? If somebody mugged you on the street, you know exactly what happened. But that's it. We have this system that mugs people constantly. 3% inflation is a slow motion mugging, and then, but this the other thing we're talking about, this possibility. So let me pull this back up again, because I mean, to me, this is a big deal. I think that this is going to create a lot of difficulty very relatively soon. Is this relatively quick explosion um, in the rate of interest here? This looks like it's on a tear to me. This is I know that the 10 years been as high as like 11-12% back in the 80s, but we had very different debt loads back then on a percentage basis, aggregate basis, every basis you can think of. So this is going to create funding difficulties pretty quickly for consumers, eventually the corporations, which, as you said, very wisely loaded up on cheap debt back when they could. But the government is not in that position. They have a schedule where they're just rolling stuff. So the 10 years that they sold 10 years ago come and due, they're going to get rolled at this new rate, which is going to cost even more, in
That's
terms
right.
of interest expense. Yeah.
And it puts the government into a situation. So, you've weaponized the dollar. So
Yeah.
now you've got a lot of your buyers of treasuries that are looking for other alternatives right now because they don't really have any other choice. The rules of the game have changed. Whether there's an alternative or not, they're looking for it. So that's less demand. Demand keeps those yields down. You've got, and what's curious to me is we broke out of a couple of resistance levels there. So you've had large institutional investors who've been willing to accept less return on a 7 to 10 year treasury than what they have on a 1 to 2 year. I guess with their belief that, hey, economic fundamentals do matter. Emotions may drive the market in the short run, and the market can overshoot from valuations, but we're willing to give up because we think that inflation from a long-term standpoint is going away. So the question is why? Why is it moving now? Is it the Fiscal Irresponsibility Act? Oh, I got that wrong. The Fiscal Responsibility Act that
Yeah.
come through irresponsible. And they're finally realizing we've got an administration and politicians that are willing to spin us into oblivion. And they're like, wait a minute, yeah, economic fundamentals are here, but we're not willing to continue to lend to the government at this rate, especially with the rest of the demand around the world looking for other places to park its hard-earned money. Because you got to think, all of us have to sacrifice greatly to save. And we want to put that money, either invest it from a long-term standpoint in a prudent place. Mm-hmm. And if we need a safe portion of that, we want to invest it into high integrity, into honesty. And even though I believe Fitch is behind the curve on this, they were courageous enough to come out and take what will obviously, I would assume, be political pressure, not to their benefit, just like the individual you're talking about, Question Yellen, gets kicked out and doesn't have an opportunity to come back in there. So they were courageous enough to step up and go, hey, this might not be reality, but we're going to at least take a step in that direction. There's got to be consequences here. And at some point, corporations are going to have to refinance or finance, reach out into that market. And that's going to dramatically change the profit levels we are. And especially with rates going higher, I just don't see how corporate profits are going to continue at these record highs that we have seen. As interest rates have gone down over time, corporate profits have gone up. So you've got labor pressures now, and you've got interest rates going higher. Really, the only thing that's going to save our government, I guess, is some event that causes interest rates to go back down dramatically again.
Well, let's talk about that real quick, because I'm going to share this now. My favorite charts. This is federal government current expenditures. These are just interest payments. Okay. So this is just what they're paying on the national debt, right? This doesn't include the so-called interest payments that get paid off to the Social Security, which has a 3% special yielding treasury bond. Not that. This is just cash out the door. Mm-hmm. And I think you can see there's been a slight acceleration of trend towards the end here. But we are dangerously close to getting to that magic $1 trillion per year in interest payments alone. Paul, it wasn't all that long ago that total income from the personal income taxes alone was about $1 trillion. I mean, now it's higher, but yeah. It's just it's astonishing to look at this, and you can see that there was like a fairly longish sort of flattish period here during the 90s, 2000s. But this is astonishing. That's what the turnip is saying. I don't know. It's puzzling. Why does anybody see a problem with that? It's just like, well, Janet, it's very simple. There's cash in and cash out and debt, and you need to be able to manage those three things.
That's right.
Look at this.
And if you're a banker and someone comes in to borrow money from you, and you're looking at their interest payments and income, which apparently tax receipts are still not looking that great, are you going to be happy to lend the money in that situation? Absolutely not. And at what point At what point does behavior change?
Yeah. Let's do percent change from a year ago. Let's see what this looks like.
It's gracious.
Oh, wait a minute. Yeah, I know I got it.
Okay.
Look at that. Look at
Yeah.
that percent change from a year ago. So it's not always the destination, Paul. It's the pace of change, right? Skydiving is fine if your parachute works well, you know?
Mm-hmm.
It's, nothing wrong with, falling out of a building is fine till the sidewalk, right? It's always the pace of change. Look at this. This is 50%, this line right here. More
That's
than
incredible.
a 50% rate of change from a year ago. We're paying 50% more in interest payments from the US government compared to a year ago. How is that not sort of like, well, don't we have to sort of like go to ask Venezuela what happened? Is this part of the how did you go broke slowly, then all at once, which you sort of riffed on a minute ago?
Yeah,
That looks
it sure looks
that's
that
sudden.
way. It really does. I've been spending a lot of time here recently studying the Weimar Republic and their inflationary holocaust that occurred over
As
there.
people do. Yeah.
Yes. And, just, I guess this is probably the third or fourth time in the past 10 years I've gone through and read, and you pick up a little bit, but, it happens all at once, and the average person doesn't realize what's taking place, and they're 3 to 5 steps behind. And that looks like a basketball that you've held underwater in the pool for a period of time, and all of a sudden now it's slipped out of your hand, and, the cat's out of the bag. The question is how quickly can they get it put back in there? Or are we off to the races at this point? I mean, the fiscal irresponsibility is just, they do not value our savings, the national savings, or the debt that they're passing down to the future. It's idiotic.
It is. It is. Well, the thing that shocked me, which I pound on the table every so often, I'm like, the Congressional Budget Office noted that Social Security is bankrupt, completely
Yes.
out of funds by 2033. That's like tomorrow in the scheme of things, right? Because there's the huge adjustments would have to be made to sort of avoid that. But already it's bankrupt in the sense that there are no cash reserves sitting in the Social Security Trust Fund. There are a bunch of
Right.
Treasury IOUs, and it is, as of now, a net drain on the Treasury, because the Treasury used to take excess, like we would put 3 trillion in, but there were only 2 trillion, that left some money after they dispensed, the OSDI and the SSI payments out, right? So there's a little extra cash. They would take that, spend it, put special Treasury bonds in, call that a trust fund, right? Bizarre. Enron tried that and got busted for it. The government does it, and we all shrug and go, oh, okay. But already the remittances through FICA to Social Security are no longer sufficient to meet the outflow. So it is now a net drain on the situation. And the only way we can fix that going forward is to vastly, vastly, vastly hike the FICA taxes,
Yes.
or to reduce the amounts people get paid.
Either or right? To postpone the benefits. What are they going to come up and say? Hey, you're not going to get your benefits to your 77 or 78 because life expectancy is in the late 60s. I mean, I've heard that argument out there. And the worst part is one thing I like to point out to people who are like, oh, well, Social Security, blah, blah, blah. It's actually an entitlement, because you have saved, you've paid taxes out of your check, out of your hard-earned money. The government has taken them. Your employer, for your employees, for my employees, we have to match that goes in. So we have sacrificed, we have set aside, because the government said we will be responsible for this and we will make sure that you get this benefit in the future. And they've known that the baby boomers were going to get here, that watermelon in the belly of a python coming through. So there's no excuse for being unprepared. No excuse whatsoever. But they've chosen to spend for today at the expense of tomorrow. And unfortunately, we're all going to suffer from that. And that's one of the things we do when I run a plan for people and look at their retirement plan analysis to show them, hey, are you on track? What are you doing? Let's do some scenario analysis. What if you don't have Social Security? So I run some scenarios that'll say, well, hey, what if you're 40, 120,000 a day at 3.5% inflation? If we're fortunate that that's all we get over the next 25, 27 years, you're going to need 258,000 a year in income, 27 years from now to have the same amount of purchasing power that you do today at 120. What if you don't get Social Security till 77, 78? So we're trying to help people prepare and say, hey, if Social Security is there, fantastic. But yes, it's an entitlement, but they've so been irresponsible with those funds. You can't assume that those are going to be there for you. And unfortunately, Chris, there's a large part of our population that Social Security is the only sustenance they have when they get into retirement, because they just didn't plan well, or a series of events put them in trouble.
I got to be honest, you know, as I climb up, I'll be 61 this year. And so I look forward and I'm like, the most I think, if I ever do see any Social Security money, the most I'm hoping for that to do is to offset my property taxes, because those are going up at way faster than the COLA adjustments for Social Security. And I'm just watching them sort of like, you know, eclipse each other, you know. Anyway, I mean, I really do. I mean, the choice I would have to make living in a high tax property tax district is move somewhere with lower property taxes. You know, it would force a decision, like we're being forced. This is why without financial freedom, you get forced by the system to either live an immiserated penury life, you know, where like 100% of my income just goes to feed a property tax system, which is bizarrely out of control, or I got to move, right? Leave everything behind, leave my garden, my community. You know, those are the choices. I really, this is why the Virgo in me, scales of justice, I hate this. It feels unfair. It feels systemically gross. And that's why the turnip, that's why I like to beat on her, because I'm like,
that's just, that is a perfect nickname. Well done. Kudos to that individual. So, but yeah, it's frustrating. And, you know, we're seeing a mass migration across the country from individuals that are leaving states. You know, I was talking to someone yesterday. They've got a $1.5 million valued property on the West Coast. You know, taxes are $15,000 a year. In Georgia for a $1.5 million property, you're talking about $4,500 to $5,500. And so you got these substantial differences, and people are finally feeling enough pain where they're starting to move and uproot their families. And we shouldn't have to be doing that. We really should.
Yeah. I'm looking here because you mentioned that migration, and without getting political, the migration is heavily away from democratic states to non-democratic states, you know, dyed in the wool blue. Hard to shock me these days, but I got to confess, both eyebrows went up when I'm looking here. I'm reading about Illinois, its unions, and Governor Pritzker. He just signed this 20% increase in their salaries, right? And so this is the classic thing, Paul, where the government and the unions are on the same side of the bargaining table, but the taxpayers don't have the opposite, you know, contract. They're on the same side of the table, and they negotiate these big fat things. And by the way, there's not a single person in the world that can say how Illinois is going to pay for that. They have one of the most underfunded pensions, and they just like handed out, like governor just handed out huge giveaways, blah, blah, blah. We're going to see net migration from people from Illinois because they're being screwed over by that system, pardon my French, and they have no say in the matter. And it's just gross to watch this happen, because it's going to hurt. And Illinois is already, Chicago, not a good place to live. No. And they're adding to that misery.
Well, and you go back to that debt, the interest payments that have skyrocketed. You go, you know, the higher the risk, the higher the inflation, the greater return the investor is going to want on the longer they tie their money up. Yep. So you've got this fiscal irresponsibility on the government level, which should be the kinsman redeemer or the big brother that says, okay, if the states get out of control, we're in a position to step in and help cover that debt. We can reorganize it if there's a bankruptcy. But how in the world is the government going to step in at this point when they're being just as fiscally irresponsible as a lot of the states like Illinois? And, you know, and at some point, people are going to be complacent. They're going to, you know, the problem is you hear the story about the boy that cries wolf. Well, you know, wolves are smart. So you got the little boy out there, he cries wolf. You know, there's the kid that goes out there and just wants attention, right? But there's also the individuals that get out there and say, hey, we got trouble coming. And it doesn't come as quickly as what the unaware person expects. And they go back to life because they're trying to you know, be proficient in their job,
Mhm.
deal with their kids, keep up with the social media, keep up with the Joneses, trying to live the quote American dream, and they become impatient. So they ignore, and then all of a sudden trouble comes, and that trouble is on its way. And I'm surprised that it's not here already. I think the massive amount of money printed by the government during the COVID fiasco has been enough to kick that can down the road a little bit longer. And on top of that, the psychological aspect, you've got investors that have been bailed out now since 2014 with QE1, QE2, before that Operation Twist. And you go 10 years, it's like Pavlov's dog, and now it's just pure speculation. It's pure speculation. Oh, they're not going to let anything happen. It is different this time. I keep hearing that. It's like, you talk to individuals who are not aware, and they're like, hey, government's not going to let everything go bad. They'll lose their positions, but that's what everybody thinks until the straw that breaks the camel's back puts everybody in the world of hurt. And I'm absolutely terrified of inflation because there's no easy way to deal with inflation. You can deal with deflation by being prudent. You can turn that into massive opportunity.
Mm-hmm.
But if we get into an inflationary holocaust, I mean, yes, there are unbelievable places that you can go if you're prepared for it, and you can be better off than the average person. But that's misery across the board. It's just much more misery from some parts of the society than it is the others.
Well, absolutely. And again, it becomes class warfare because people who are wealthier have more opportunities to invest in the sorts of assets that have a chance of, somehow keeping up with inflation. But I will remind people that, the Venezuelan stock market during this period of punishing inflation, which is still going on, rose 600,000%. That's awesome. Unfortunately, inflation rose 2,000,000%.
Yeah.
Not awesome, right? So there come times when even, you're because corporations through the stock market, they can't keep up either, right? There comes a moment of inflation that's just unkeep upable with, and that's just a normal process. Now, I think, guess what? Trying to move a super tanker by turning the wheel takes time, and the United States is the super tanker. We got a lot of inertia in this thing. The dollar's not going anywhere anytime soon. But I keep talking about this, Paul, which is the one thing that I think is going to get out of their hands. And so I could be wrong, but this is how I see it. Is select that. There you go, and we'll share this. So oil. Now,
Oh, yes.
the United States, if I put it up here, a chart of the Strategic Petroleum Reserve, which is neither a reserve anymore nor strategic because it's been used as a day trading device by the president and his handlers, I guess I should say, to keep the price of gasoline down. So we've just been raiding the piggy bank in order to keep oil flowing, but oil prices down. But this is a chart of global oil inventories. It's by Eric Nuttall. He follows this like a hawk, so I follow him like a hawk. He says it's been a long, exhausting wait, but global oil inventories, both onshore and oil on water. So this is tracking everything. These are tankers floating around. Sometimes they park them. That's the cheapest way to store 1,000,000 barrels or two. But anyway, everything we know about current global inventories are now at a 6-month low, and we expect they're going to be going down. So global oil inventories are down. And so this chart, for anybody having trouble reading it, goes way back a bit, but you can see that big spike there, in the 2020s, right? So that, big spike.
During the COVID shutdowns, when I drove through Atlanta to go visit family during COVID, and I think I saw 2 cars on I-75. That's something I'll probably never see in my lifetime. So imagine what this would be like without that refilling of capacity that was there during that period of time. Of course, you did have shut as well. But.
Yeah. So the oil fields still produce. You don't just turn them off because COVID, right? And nobody's driving in Atlanta. So that led to a huge increase in inventories. That's mostly been worked off. And of course, missing from this is the context of just how much the United States raided that piggy bank too. So yes. That's all part of it. But maybe it's making too much of something. We can see this is oil over the past year. This is the $100 line right here. If you can see, wait, I'm not sure if people can. I never remember what insert to file home. Anyway, I'll just have to draw a line on here. So that's the 100 mark right there. Oh, the line's not working. But you see here at the right end of this chart, we see that oil's gone from 70 to 80. Now that's range bound. It's been at 80 since, last December. So, whatever. but I think it's beginning to signal something's going on here. It's starting to bust a move, even with the lots of stories about how there's economic slowdown and China's beginning to slow down. Normally, oil's very responsive to all that slowdown talk. This time it's going the other way. And I think it's because our inventories are down. And also, as you mentioned before we started recording, Saudi Arabia just said, maybe we'll cut some more.
They did. So, well, and if you're looking at a government that's willing to be completely fiscally irresponsible and they want to, paper over everything, your greatest risk is going to be inflation. So let's say you get deflation in the short run. One of my big concerns has been we have another, one more 30 to 50% decline in the market. Okay. Maybe it started last year and just all the money and the psychology and the speculation is drawing this cycle out a little bit more. We get this big bounce into the summer. Yeah, a lot of historical measures will show that when we're this high in the first 6 months of the year, that we've never been negative for the rest of the year. But there's a lot of things that we have right now that we've never had during those periods of time in the past. So, is it different this time? Is it similar to the past? I think that's one of the reasons for a lot of optimism. But if I'm sitting here looking at it and I know the why, so with my son going to Georgia Tech, we had a conversation here recently because they're starting football camp. His first summer of, hard college classes, and now he's getting into all day long in football. I'm like, son, why are you doing this? Because when it gets hard, you've got to remember the why. So these big institutional investors keep their picture on their eye on the big picture. They're not like us, a lot of retail investors that are influenced by CNBC, their brother-in-law. They know where the big trends are going. So if I'm looking at inflation over the long term, even a downturn in the short run where the price might drop, okay, we're showing this area of resistance trying to break out. If we do get the Goldilocks scenario, then oil and energy, not a recommendation because we have to talk to each of you individually, should be a phenomenal place to be invested. So even if we get the downturn, if you got some exposure, you get that decline, then you can average down into that and add to it from a long-term standpoint. But again, back to that inflation, let's say we have a big downturn. The government says, hey, we printed tons of money in the past. Let's just print more, right? And then we get inflation that gets out of control that we cannot raise rates to stop. I would much rather own energy in an environment that governments are expecting us to, or driving behavior, driving an investment cycle into alternative energies that we just don't have the technology there yet. So you've got a gap where if you're an oil company, you're punished if you have profits, right? You've got windfall taxes that they're talking about putting on top of you. So that's going to keep you from reinvesting back into infrastructure. So that demand that supply continues to be constrained, but the alternative energies haven't come along fast enough to create that demand. So it's a phenomenal, unfortunate upside potential that causes a lot of people pain that have to consume it, but could be something that helps keep purchasing power and provide financial freedom for those who can keep their eye on the big picture and invest responsibly. Again, not a recommendation, just something to keep your eye on.
Yeah. Now I track oil as closely as I do because it is the input feedstock for all sorts of things. So the Fed will do everything it can. It'll jawbone, it'll lie. I keep asking people who are financially savvy. I throw up that chart, and I could pull one up from today or yesterday showing all the global markets in the West are just linked now. The equity markets are just like one thing. It's the Borg, it's the hive mind. Germany goes up, we're up, Japan's up, small stock. It's just this weird thing, right? So that fits in with your thesis of this is a speculative market now, and it's all this money sloshing around and all of that. That's all fun and games, and they can keep doing that unless they have a forcing function. So what are those? Well, I don't know. The petrodollar starts to collapse, and they have to defend the dollar by raising interest rates, even though they don't want to, because that leads to runaway, interest payment expenses for the government at all. Or it's something like oil just starts to go up because once you understand where we are, and it's a non-negotiable substance. I don't care how bad the economy goes into recession, people are still using oil for all sorts of reasons. And the main thesis they've had out there, Paul, was like, oh, electric cars, those will reduce gasoline use, so we're going to use less oil. And the answer is no, it won't, because we still need the diesel, we still need the asphalt, we still need all this stuff. Nate Hagen's talked about this a while back where he said, look, we could stop burning gasoline entirely and we're still going to produce as much oil and consume it because we need the asphalt, the diesel, the jet fuel, et cetera, right? The gasoline will be this byproduct we don't know what to do with anymore, you know. But so we look, but I think we're way behind the eight ball. We've told ourselves stories that don't make sense. Electric cars are going to make oil go away. We're going to hit peak oil demand. It never happens. Every year the world's consuming more and more, and now there's less and less of it. I think this is what's shaping up, is going to be a forcing function. And then we get inflation that's resistant. It doesn't matter what the Fed does. Raise interest rates, lower interest rates, take away reserve requirements for banks, give them interest on excess reserves, play your games, and the price of oil is still going to be feeding in, making everything more expensive. So
That's right.
that's the forcing function I see.
Well, and imagine what oil would be doing right now. So you're already in this trading zone and it's trying to break out of resistance, with Europe, by all means, in a recession, with China, which we expected to have this massive recovery. There's a huge number of people that are there, which is an unbelievable demand, and their economy is struggling and slow right now. So if you get those economies to start firing on all cylinders, you know, we're way behind that demand schedule. And then you take all the momentum traders and the computers, that price could move to 150 in a very short period of time, just because everybody deciding, oh, now this is on our radar, we've got to start putting capital there, and then it feeds itself. So, you know, yeah, we seem to be in this period of time where, and it's hard to see for a lot of investors because the market has been so strong this year, and the economy's been resilient from the standpoint that we are still declining, right? Like, so today, I think it was, we had, if I look at the, get the numbers correctly, we had ISM services. It wasn't ISM services. It was one of the numbers came out today and beat, but we're still declining from last year. So it beat the expectation, but we're still like 0.25% below what we were last year. So we're still declining, just not as fast as we anticipated that we would here. And so I lost my train of thought there when I started looking at those papers. But you know, we've got a dangerous situation where we just don't, if this supply comes back and this demand comes back, we can't keep up with it. And then that just continues to feed, hurts corporate profits, and continues to drive salaries higher because people are going to need more wages. And then you've got the input costs that go into our food supply. So that's could potentially be the driver of inflation, that, like you said, no interest rates are going to do it unless you literally just destroy the economy to stop the demand.
Right.
Painfully.
Right. Well, I mean, yeah. And of course, you know, the antidote to all this would be actually having a credible, thoughtful plan for energy, for our economy, you know, for lots of things. We don't have any of that stuff going on right now. We got turnips, you know, nothing but turnips all the way down. So it's just that's why I'm contrarian bearish on the whole thing, is I'm not seeing the kind of leadership that we would need, because this is now we're down to, you know, Thomas Sowell said that you know, business is just a series of trade-offs. Those are the decisions you make. You know, do I do this or that? This has a pro, this is a con, vice versa. So we don't have anybody seemingly ready to make those decisions. We'll send all this money to Ukraine, and, you know, we'll you know, give the unions whatever they want, and, you know, it's just all this, like, it's childish. So we'll get to that sort of breakdowny part now in the time we have left, because we're almost out. But I'm curious, what are you hearing from your clients? Like, what's on their minds? What are they concerned about? Like what kind of questions are you being asked these days?
So that's a really good question. I'm getting try to summarize what I'm getting. There's a lot of concern out there. There's a lot of concern of what they're experiencing, what they're seeing in the economy around them, and what they're seeing in the markets are two completely different things. So the question is, you know, how can the market continue to go up? Our business is a little bit slower. Yeah, it's not falling off the cliff like we expect. But more than anything, I'm getting questions about, how do I protect myself against inflation? Because people are starting to finally feel it, all the way up to the upper middle class. Now, the top 10% aren't feeling it as much as everybody else is, because they've just got so many assets and they've got so much cushion in their income. But you've got upper middle class now. They're starting to ask questions and starting to make different decisions in their purchasing, because food inflation, I'm hearing more comments about how much they're spending at the grocery store. I need to upgrade my car. Cars are ridiculously expensive. You know, those that are needing to borrow to purchase a car or upgrade, or just like, I can't afford it. They're talking about their kids getting rejected for auto loans. And I'm also starting to see a lot of regret for some of the impulsive purchases that have been made over the past, 24 months, let's say. Because at least in our area, we're a big VRBO. North Georgia is a big VRBO rental. So you've had a lot of people that have purchased these rentals, and I'm hearing across the board, they're 20 to 30% lower than what they were before. People did not anticipate that trend would revert back to normal. Yeah, it's probably going to be higher than what it was before, but there's some regret and some fear that's coming along in those purchases. Nobody's making any decisions right now, but they're starting to realize, hey, maybe I was a little over optimistic about where I was. So, so questions about, how can I handle this prudently? It's not that often that I have people come to me and say, hey, I'm a little concerned about the underlying economy and the markets. What if the market takes a big decline? Where are we going to lower risk? Should we do some of that now? Because a lot of times I have to push people out of their comfort zone when the market's sold off big time, and I have to pull them back. But there's just a lot of concern out there right now, an extreme amount of concern. And for the first time ever, one thing that was interesting, there's a lot of political conversation. And I really do my best, Chris, to avoid. I always tell everybody I'm a political atheist. Okay. And I'm an equal opportunity basher. I have to be for what we do. And so, and I always say, look, I'm not an atheist. I believe in Christ. I am a Christian, but I'm a political atheist. So, but there have been more political conversations about just how kind of crazy things are. I mean, this is 15 years in a row now that we've gone out west on our trip, and I think we spent 3 days of conversations about politics. It's like, what can we do? And I think people have reached the point that they're willing to take some action, close to taking some action. I don't think they're quite there yet. They've not experienced enough pain. But those are the conversations I'm having right now. Just a lot of frustration, a lot of concern. It's nice that the markets are up. It's nice that portfolios are up. But how do we keep it? What are you hearing?
Yeah,
I'm curious in your conversations.
I live by the anecdotes, because that's at the edges is where we find out that things are shifting. And there's been a profound shift in the last couple of months. And I don't know if we've just sort of busted through some sort of like new membrane where it's okay to talk about this, but that's how these things happen anyway. I am. So we had a really beautiful thread opened up. I do these daily takes the happening now section in the forum at the website. And there was one, I just asked the question, like, what are you going to do about it? Right. Because there's all this stuff happening. It's like, well, what are you going to do about it? Like not pitchforks necessarily, but in your own personal life. Anyways, it's kind of an open-ended question. And man, people mapped into that beautifully, really beautifully. And it mirrors a lot of the conversation. That piece got triggered by a bunch of conversations I had just this past weekend. Well, people call me up and say, I don't know what's going on, Chris, but I've been waking up at 3 a.m. I can't resolve. There's some feeling. People have been saying, I've been preparing, but I don't know why. I'm already prepared, but I just bought more food. And other people have been reporting that they have this sense that they really should be doing things, but they can't find the motivation anymore. It's just like something's happening. And I think that we humans have incredible cognition, but our main sensory position is actually intuitive first. There's as many neurons down here. There's 3 pounds of nerves down here. There's 3 up here. You could run this whole thing with a pinhead sized nerve ganglia. Like, you don't need a whole extra brain down here. So what's it doing? And so that's why I don't discount intuition. It's operating on some stochastic method. It figured it's a probability weighting machine. It's not linear. Anyway, I trust my intuition. So when people are coming in and checking in saying, my intuition, my spidey senses are jangling, I don't know why. Often I have to map that back into things after the fact, but I trust that something is up now for people. That's why I asked the question, because I'm just gathering,
Yeah, I think you're right there. People can't put their finger on what it is. They don't know how to ask the right question, but there's a level of concern. Just as I think about all the different questions I've had come in, there's a level of concern out there that I've not seen in quite some time. And, and really haven't seen since after Lehman Brothers collapsed in 2008. And I can differentiate between market action prices, because we by God's grace had used the tools that we use and had sidestepped that collapse at that point in the market. But people were just concerned about what was taking place in society, what was taking place in the banking industry. You know, the move that they could see taking place, wiping out the small banks and handing them over to some of the, you know, connected regulators, and just the wealth that wiped out of the small communities. And I sense that out there again. You explained it much clearer than I was able to, but that's what I pick up on as well. There's a concern out there. People don't know how to put the finger on.
Yeah, and this is why I actually track the markets, because I do think that they're manipulated, they're full of speculative froth. So the signal is no longer, it's been swamped by a lot of noise. When I see all the world's markets move up and down in parallel, where's my signal? You know, how am I supposed to, like, what do I draw from that? You know, there's no difference between Germany and small caps in the US. Weird, right? So but leaving that aside, you know, you mentioned the George Gammon interview. He gave me a really important piece in there that I hadn't considered, which was, and I should have, because I'm a Mr. Market tells me things that out here in the cheap seats, again, I have to understand it after the fact, but he was showing that in August of 2019, the bond market was already telling us something hairy was on the way. And like, why does that happen? So you mentioned it. You get your Fidelities, your State Streets, your big money, right? They don't just go out and say, you know, I'd like to underweight, you know, this. They have $1 trillion problem. Like, what do I do? You know? So when they move, that's when you see things like yield curve inversions, or you start to see like big giant markets begin to bust a move, like the treasury market selling off. And I don't know why, right? Out here in the cheap seats, I can't tell you, but I can tell you, I can see the fingerprints. Somebody's repositioning themselves, right? Because it's impossible for them to do it totally silently, you know? So that was interesting. You know, somebody was pre-positioning themselves for COVID. And then that whole thing you mentioned at the Davos thing in January of 2020, that Paul Tudor Jones had come out and said, oh yeah, you know, we know, like he was talking about it in January 20th, 2020, as if he'd known about it for a while. And meanwhile, our own Anthony Fauci's like, well, we just found out about this in December 31st when China told us. Like, no, that's not how any of this works.
You know, and I was actually cutting grass last night when I was listening to the interview. And the first thing I came in this morning, I'll show you here on my chart, if I can make sure I can share this correctly.
Yeah.
What I started looking at, there it is. And let's see here. Can you see that, Chris?
Now I can. Yeah, sure can.
Okay. So what I was noticing, this is actually October of 2019. And you notice there was a change in behavior of the market. And I mean, don't get me wrong, you'd had some nice little rallies there, kind of late 2017, little blow off, but all of a sudden you've got this vertical move. But you've got the bond market that sees something coming. You've got Paul Tudor Jones talking in January about having some knowledge here, and the market just continues to go straight up into that decline, right?
Yep.
And you know, and here we are in a situation where you've got a narrative that's taken off again. Market starts to sell off. The economy is still deteriorating, and yes, granted, it is holding up much better than anybody anticipated at this point. But you've got the similar behavior that's taking place right here. And what frustrates me the most is these are the type behaviors that suck the retail investor in. And that's the hard part. You know, the question is this a really a genuine move in the market? Is it just a speculative move? Or I'm going to share one more chart here. And bear with me. There we go. Or have we got a situation here where that move in the market, you've got these individuals that know, and you're using gamma squeezes, which is a technical situation, and basically just kind of oversimplification of what that is. If I guarantee somebody a certain price on a stock that they purchase for me in a call, and the price continues to go up, I have to buy that to reduce my risk. So you've got this forced buying that takes place, and it just sucks those retailers in, the retail investor in, because they're speculating on a short-term move. They have been emotionally just destroyed with the markets continuing to run. So now they're just, hey, the government's going to save the day. They're sold to right before things turn, get a little bit of instant gratification, and then they end up selling, and continue to repeat until broke. So
Yep.
that's the game that Wall Street's perfected in over the last however many years, unfortunately.
Yeah. Yeah. I just, Evie and I, we just rewatched, we're trying to find anything of value to watch on Netflix. And we keep
Smart.
opening stuff. And like 5 minutes in, we're like bored because they've dumbed it all way down. It's just like, oh my God, a formulaic plot. I know exactly how this unfolds. The dialogue is trite. So guess what? We end up rewatching Shawshank Redemption, all that. But we rewatched Wolf of Wall Street, right? Fabulous movie for people you should watch because it really lays bare how Wall Street works. And of course, it's set against this, oh my God, the SEC and the FBI come in and save people from this shyster. But they don't show the fact that JP Morgan and Citadel, they're actually they're the big shark shysters, and they are all running a scam, right? Because there's that one scene at lunch with Matthew McConaughey and Leonardo DiCaprio, and he's like, what do? We go home with cash every night. Our job is to keep everybody fully invested. So those little spikes you see, I'm jaded enough that I think those represent Wall Street has some product they got to move. Mm-hmm. And how do you sell product? You got to create some sizzle. You got to get some excitement going. So it's a scam they run. They always have these blow off tops into the end of a cycle. And it's like, how have people not learned about this yet? But that's their sales game, right? They know their market. Right. You create a lot of excitement. You create this massive momentum. You create the FOMO. You offload all this dodgy product you don't want anymore. And oops, so sorry for your losses, Joe and Jane Sixpack. Look at my new yacht.
Right. And there's
how it's been.
There's always somebody new in their early and mid 30s or early 40s that haven't experienced that cycle, like the individuals that got sucked into the technology boom in late 1999 got wiped out. Well, that changed their behavior in the market for quite some time. Real estate, changed behavior in 2008, but now you've got a whole group of individuals. You've got a whole group of new money managers that are coming in that are not, in the C-suite or in the know.
Yeah.
That just don't believe that you can have that type of a downturn or that something like that will happen. But it's been repeated so many times in history that has. And this is a time, like I said, we're in the danger window. This is time to be patient. This is time to be cautious. This is a time not to chase your brother-in-law's returns. This is to focus on your long-term goals and objectives. And that's one of the reasons we run, like I run these retirement plan analysis. Are you on track? Okay, so what's your risk? If you're way behind, yes, you have to be a lot more aggressive, but you don't gamble right now, right? You might be aggressive in being more conservative, maybe use some puts. That's one thing that's interesting right now, and I forgot to talk to you about this. Insurance against the market downturn right now is the cheapest on record, or damn near it. So yes, it's the cheapest on record right now. So you can buy downside protection on the market for the cheapest that we've seen. And I cannot remember who put that out, but I looked at it. So nobody's interested in protecting against the downside right now. Now, I'm not saying go out and short this market. That's a dangerous thing to do right now. But the reality is, this is the period of time, like Buffett's proven time and time again, and legendary investors don't chase what everybody's fighting and crawling over each other to get. Buy the thing that's overlooked. Be patient enough to hold it for the long term. So, it's important to know why you're investing. It's important to know where you're going. It's important to know those risks and stay focused on those.
Well said. Well said. So listen, for anybody who's interested in talking with Paul and his team, you can go to peakfinancialinvesting.com. It's a URL. There's a form you fill out there, and then you can get a free, no obligation conversation with Paul and his team. I highly recommend it. The feedback we've been getting has been extraordinary, Paul. So great job, being who you are, and so glad to be able to direct people your way. And this is a time to be well, as always. I'm Mr. Prudent, Mr. Cautious. First, take no losses. That's my Hippocratic oath of financing when it comes to crazy times.
I've enjoyed meeting every person that we've met so far. Chris, you have a phenomenal community. I mean, just people that are eyes wide open. They're looking for like-minded people to help them make wise and prudent decisions. And everyone on our staff is just just thrilled for every single person that we have met. So it's just incredible. And hey, we have great conversations, and we've had a couple people that, hey, it's not appropriate for us to work together, but I was able to give them some information that helped them better prepare, make some pretty good decisions. So, don't hesitate to give us a call. We're not high pressure. If we can help you, fantastic. If we cannot, then hey, we've met some like-minded people, and I'm a resource that might be available to you in the future.
Fantastic. Well, I really appreciate all of that. And I know people have too. I've gotten some great emails. So with that, thank you so much for your time. We'll see you, I guess, next week. And thank you so much for your insights into the market here today. Much appreciated.
Thanks, Chris. It was an honor.